The rules that we all learned over the last, from 1980 to 2018, they're not helpful, right? What they wanted pulled out of the portfolio was the one thing that saved them. Let your winners run, cap your losses, have realistic expectations, and have money management discipline. It's been very profitable, but it's lumpy and it's uncomfortable, meaning that trend followers, generally speaking, are only successful on about 30 to 40% of their trades. Passive equities and systematic global macro are a great team. I was just kind of blown away at how competitive market cap weighted large cap stocks have been when you factor in all the costs. If I just assume everything's going to become 100% correlated and go against me at the same time. The truth is rarely at one end or the other. But it's rarely in the middle either.
You're watching Excess Returns. I'm Matt Zeigler, my co-host today, calling in the big guns for this one. Mr. Mutiny himself, Jason Buck, is going to join me. Now, damn it feels good to be a gangster, and damn it feels bad to be a trend follower. I think we established that before we launched in. We've got Eric Crittenden, founder and chief investment officer at Standpoint. Eric, welcome to Excess Returns.
Thanks for having me, guys.
All right, Jason, you ready to do this with me? We got all the hard-hitting trend following questions that everybody's dying to know the answer to right now.
Yeah, you're going to ask all the questions. Eric's going to answer them, and I'm just going to listen intently. This is great.
Do your best Munger impression and just say you have nothing more to add. Great.
Exactly.
Thanks for being here. All right, Eric, we're starting with this. The market owes you nothing. It's June of 2025. Do you start to want the market to owe you something again maybe right now? Or how are you feeling these days? What's going on with the business?
Yeah, we feel good. Performance from trend following over the last, I'd say, year and a half, maybe 2 years has been challenging. Not a lot of fun, but we knew that coming into it, that you don't always get what you want. And there's a price to pay if you want to be different, if you want to diversify, and you want the benefits of long-term trend following. Well, there's costs associated with that too. And there's certain market environments where you're just not going to get a pleasant experience. So we knew that going into it. We had a nice run for 5 years, with very little downside from the macro trend side of what we do. But for the last 18 months or so, it's been probably the most challenging environment that I've seen during my career. So, yeah, not easy times, but it's to be expected from time to time. I expect something like this at least, once every 8 to 10 years.
But we have SocGen Trend Index is what, down, the worst it's been 25 plus years on something like that. It might be even worse now, but but you always paired it with buy and hold equities. But then at the same time, you don't want those to go, they're uncorrelated, which sometimes means they can be correlated together. So I'm just curious, like you've been in this business for decades. I'm just curious more, like, how do you think about those drawdowns? Like you said, this environment could be expected, but you can't predict this environment. So, but then you have clients that were real happy with you for years, and then now they may be asking questions. I'm just curious, like, how you think about this and overarching your multi-decades in this space.
Sounds like there were 3 questions embedded in there. So let me take a
here we
stab.
go. Eric's going to make fun of my questions.
These 3.
Yeah, so I've been managing money for, like you said, a few decades now. And there's different kinds of clients. There are clients that do a lot of due diligence, that they make you jump through some hoops so that they can best, or they really work towards understanding what you do. And I feel like maybe half of your clients are like that, and then another maybe 25% of your clients do the due diligence on their own. They may be savvy, they may have a lot of experience investing in the space, and they feel like they can do it themselves, and they don't spend a lot of time digging in by asking us, the portfolio management team, questions. And then the balance, say, anywhere from 15 to 25% of your clients, you don't really know who they are. They're buying a track record, they're buying something, some sort of a beta or an alpha that they want in their portfolio, and you never really know them. And some of them are chartists, some of them are nervous, some of them look at the track record and say, hey, the worst drawdown you've ever had is X%. That's great, and your returns are compelling. So I'm just going to assume that's what it's going to be like forever. And they buy the fund, and then you end up at some point in the future having a drawdown that exceeds, what they saw in the preceding years, and they feel like, well, something must have gone wrong, or I don't want to defend this, and they move on. So long story short, what I've told my partners and coworkers is if you do a really good job, 2/3 of your assets under management are yours. And 1/3 has to be considered transitory. It can disappear at any time. That's if you've done a good job of prospecting and developing relationships with your clients. If you've done a bad job, you can flip those numbers, and you've seen firms have 70, 80% declines in their AUM. In hindsight, I think that's probably what happened is they probably had a great looking track record. They didn't really know their clients. Their clients didn't really understand what they were buying. And when it went out of favor, 2/3 of their clients or more disappeared in one quarter. So thankfully, we haven't experienced anything like that. I hope to never experience anything like that in my life. But right now, the clients that have left have been a small minority. And in my experience, yeah, I would say it's the people that we just didn't know. And they bought the program for the wrong reasons.
It's like it's volatility in the arrow of time, right? Our largest drawdown's kind of always ahead of us. It's just been decades since we've seen this kind of a sharpish drawdown in trend following. But like, I want to think about it from two perspectives. One, the clients that you guys have educated, that you guys are very like-minded, that are happy to be in your products and everything. What do you think is like fair qualms that they have, or they're calling you up about, even though they're probably going to stay in? But like, what are their concerns that you think are relatively fair concerns with being having a trend following product?
Yeah, the main one would be, as we built our own systematic macro program. Some people call it managed futures. And we blend it with passive global equities. And then our cash balance goes into a laddered treasury bill portfolio. So I like that mixture. I think that, given our skill set and our resources, that's the best way for us to compound wealth over 10, 20, 30 years into the future. I like how those asset classes work together as a team. They tend to be uncorrelated. They tend to be very complementary to one another. When one asset class is out of favor for 5 or 10 years, the other one's usually, pulling more than its own weight, and vice versa. 1970s are a good example where equities were essentially dead money with big drawdowns, at least in real terms. And managed futures, generally speaking, had, really above average performance. And then everyone knows about 2002, 2008, when trend followers delivered healthy returns. But that relationship doesn't hold up 100% of the time. Empirically, it's like 75 to 85% of the time, depending upon how you're viewing it, where systematic trend, systematic macro delivers the diversification in the way you want it when stocks are going down or when bonds are going down. So if you want essentially guaranteed protection all the time, well, Jason, you're kind of the master of this area. That's tail risk hedging. And tail risk hedging is a different discipline. And generally speaking, it comes with a cost. It's kind of a form of insurance. You kind of need to pay for it. So that's one concern, is that when macro loses money at the same time as equities, you're going to see downside returns. You're going to see negative returns in a product like ours. So even our most sophisticated clients and the most educated ones are asking, well, how bad can that get and how long can it go on for? And those are fair questions.
What's your response? Yeah, what's your answer to that?
How do you answer it?
Come on.
Yeah. Well, so there's two answers and both are truthful. One of them is we don't know what the future's going to bring. Like, you give me any strategy and I can create a market environment that will smoke your strategy. I don't care what it is. I can, it's a certain permutation of events can take out any strategy, buy and hold, convertible arbitrage, long short equity, systematic trend. The question is, what are the odds of that happening on your watch, right? So can it get worse? Sure. Anybody who says this is as bad as it can get, it can't get any worse, you should be running the other way. That's just never an honest answer in this business. I said there were two answers. Oh, the other one is, well, we can look at the empirical data. So all my research goes back to 1970. I like the 1970s because it captures a market environment that I think is very plausible, that almost no one's prepared for. More and more people are starting to think about what happened in the 1970s. But when I started Standpoint, very few people were talking about stagflation, challenging bond market environments, real returns being pressed, gold being in a bull market, that kind of stuff. So empirically, we can go back in time over the last, 54, 55 years and get a feel for how bad it can be. And we've done all that work and we've tried to be transparent with people about that where we can. There's some compliance concerns around, showing certain kinds of research. But in terms of setting expectations, we've always told people, a 20% drawdown is certainly not out of the question. And I fully expect to experience something like that, and probably a little bit worse, at least once during my career, probably twice. So it shouldn't be a surprise. So setting expectations based upon empirical data is one way to do it. You can get a feel for just how often stuff like this happened in the past. You can do Monte Carlo simulations. There's challenges with that, but it does kind of set a range for helping you set expectations. But the bottom line is, we're going into a very uncertain future. And you hear people like Gunlock and, the guys over at Bridgewater talking about this all the time. What they're essentially saying is we have no idea. Like the rules that we all learned over the last, from 1980 to 2018, they're not helpful, right? Like, Fed's trying to lower interest rates go up. The bond market disagrees. Gold's an asset class now. Things are just different. So do we really know, how difficult is it to set realistic expectations going forward, which is why I love systematic trend, right? Because it's one way of just saying, I don't know what's going to happen in the future, but I do that the principles of professional trading or professional investing, which is let your winners run, cap your losses, have realistic expectations, and have money management discipline along the way, is my best educated guess about how to proceed in a responsible manner.
There's a couple of threads in there, Matt. Let me pull on, and then you can get us back on track. Because that was kind of part of my second question was one, how do you communicate with clients, which you're saying perfectly, and then two, I always think about, it's one thing to look at a backtest going back to 1970s, right? And you look at that chart and you're like, oh, that's no problem. I could live through that over the long term. But then at the lived experience, and then as managers, it's worse because we're looking at that P&L daily. But you're always very equanimous about it. But that was part of my question is do you look at historical analogs? But I think what was interesting of what you said is looking at the 1970s of what could happen. But then, if we pull out the 1970s, right, we came off the gold standard, we had lower levels of debt, those sorts of things. But I think you said it in it's setting expectations, right? Is that it's not exactly going to be like the 70s and you're not pitching that, but that's an expectation that it's within the realm of probability or possibility. And is that kind of the way you set it up for clients or the way you think about it?
Yeah, I'm trying to pull out, the worst data points that we definitely would have experienced. I also scrambled the data thousands of times to come up with, thousands and thousands of different permutations and path travels and traveled and pull out the worst experiences and say, this is a pretty good proxy for setting expectations about how bad things can get going forward. It doesn't mean that it can't get worse than that, but it can be at least this bad, so that people, have that in their mind when they're making a decision.
And then part of that, I think you and I talked about this privately a little while ago, is we're seeing a lot of the CTA community coming out and saying, well, during the first 10% down move in SPY, especially you saw this in the first quarter, is that's when commodity trend following doesn't really do it. It's more the second leg down from 10 to 20% and beyond. That's when it captures it. But as you and I know, there's no guarantee of that. And they could get whipsawed for the rest of the year and have drawdowns and have egg on their face on explanation. So I know you're not really saying, well, we just missed the first 10% leg down in S&P. We capture the second. I mean, why do people say that? Or they're just saying anything to keep clients invested?
A couple things, they're under pressure to say something, right? It's kind of hard to defend systematic trend because you don't have a tangible, it's not like a value stock where if it goes down in price, it's just even more of a value. There's this tangible element to it, right? They've got, plant and equipment and whatnot. So yeah, they got to say something. But there's an element of truth to what they're saying. But they're leaving out an important part, which is what you were saying. It's so in 2002 and 2008, that was a valid observation. We didn't catch the first 10%, but the next 35 we caught because it kept going down with no meaningful rallies. We didn't get whipsawed. But what can happen is that it can go down enough to pull you in and have you establish all these short positions, and then all of a sudden rally, and you're going to lose money on that, and rally enough to trigger your money management rules, and you close it out, and then it can just roll over and go back down again, right? And then you have to short it again. So you can get whipsawed, twice, 3, 4 times. And they don't want to talk about that, but that's a credible risk, and we've experienced some of that in bonds and energy, not so much in stocks, but that it could play out that way. So yeah, they're just leaving that part out. So what they're saying is technically true, but it only covers one scenario out of so let's say 3 or 4 possible scenarios, not all of which are bad, but that one that I just articulated is pretty painful.
Yeah, the coin flip, the coin has no memory, right? We have to remember that, on those whipsaws. And then I think you hinted at exactly though what you can say to clients or what gives you peace of mind is like when you build these strategies, you've been in this space for decades, you truly believe in, breakouts or trend following or systematic macro, whatever you want to call it, is, especially if we're in a regime shift time right now, allegedly with like a liberation day or all these other Trump policies, is that eventually we settle into a new regime that has trends to it and you're expecting to capture those trends. And like you're saying, if people are like, I don't know what's going on in the world, I don't know what the future looks like, then the argument would be trend following type strategies are the best bet for that unknown future. Is that what gives you peace of mind?
Yeah, it is. It's what gives me peace of mind. I don't really know how best to communicate that to people. It's kind
Yeah.
of, because you sound like a broken record
Yeah.
from what they've heard from other managers out there. Is like, hey, look, we're way out of favor. We suck right now, but that's the best time to buy us, right? Like everyone's been saying that my whole career, right? And that's not true in a lot of cases, right? It's just empirically not true, but it happens to be true for systematic trend. Like think back to 2008. People like to point at 2008 and say, "Oh, systematic trend was just amazing." No, it wasn't. It was horrible for the first 8 months. It
Yeah.
was a
Q4.
nightmare. I
Yeah.
know.
Yeah.
I was running a fund of funds, and I had half my money in systematic trend, and clients were screaming at me, and what they wanted us to do. What they wanted pulled out of the portfolio is exactly what saved them in the end. Having a break-even year in 2008 with half the money in stocks and half the money in systematic trend. So, but what they wanted pulled out of the portfolio was the one thing that saved them. So, um, yeah, going forward, I am able to sleep at night and be at peace because I have a set of rules applied to, 70 different liquid futures markets around the globe that gives me like a legitimate, realistic shot at capturing any trends that develop in this future that no one seems to be able to want to try to predict because it's not very predictable. So I sleep a lot better knowing that I have that ability, the flexibility to kind of rotate and stretch and go wherever the risk premium end up being. Now, the transition period between here and there, that's painful. Right. That's the problem with trend is that trend works when you have trends, but it just gives a lot back potentially in the transition from one regime to the next. And that's what we're in the midst of right now. And that could be over. It could just be getting started. We just don't know. There's no way to predict that part.
The other thing you hinted at is like, so it's, I think the hard part is like when you're like you or I, you build these strategies, right? Like you have supreme confidence because you know all the decisions you made to build that strategy. Like you're deep in it, right? It's all from your own purview. And then I think once it starts having those concentric circles out with clients and then clients of RIAs, right? They're going to have less confidence in you because they don't know all the decisions that were made or the decisions not made to have the proper backtest and the proper system set up. So, but like, God, it's been almost 3 decades now since I started studying like trend following and really fell in love with it. But one of the things I noticed right away from trend following is like, well, if I truly believe in this strategy, I would want to scale trade that equity curve, right? I would want to be adding into these drawdowns, which is like the scenario we're kind of in right now. And when you have a more broadly diversified portfolio with ours with rebalancing, that's what I'm trying to do. I'm trying to scale into those drawdowns from trend following from other parts of our book. Now you have a similar setup by having those long like buy and hold global equities, but maybe when they're correlated and they're going down at the same time, it makes it a little bit harder to rebalance from there. So are you guys like reaching out to clients and saying, hey, now is a good time to maybe be dollar cost averaging and really adding into a drawdown like this and maybe showing them kind of like probabilistic regimes in the past of like why you should be doing that? Or is it just, just kind of wait and see and most people aren't willing to kind of double down, as the strategy is in drawdown?
In my experience, that argument mostly falls flat with clients. Historically, like they don't want to do it. Now, there are some clients that come to us with that type of logic, and they're very easy to deal with. And you simply answer their questions and give them the information that they need to make a good business decision for themselves. But that's a minority of clients. It's not such a minority of assets because they tend to be larger clients, but it's a minority of clients. I haven't had a lot of success proactively reaching out to people with that message. And it's not because the message isn't true, and it's not because they can't understand it. It's because every other manager on the planet comes to them with the same message when they're out of favor, right?
Right.
So it's just one of those things where that conversation is they're fatigued by the concept of a manager reaching out saying, now's the time to buy us. We're down 10 for the year or whatever. So that's a challenge, right? That's just a social thing where people are just tired of you asking them to put more money in. So we don't spend a lot of time doing it. We're stand ready to help them, with all the information they need to make the decision themselves, but we're not super aggressive at reaching out to people saying, hey, buy more.
We should set up like a form of like the insider trading website that shows when managers are buying more of their funds, right? As a social indicator, right? That we're doubling down even into our own drawdowns. So Matt, please get us back on track. Sorry, I had to address like drawdowns right off the jump because I thought it was the most interesting, what everybody's talking about kind of in trend space. So I wanted to.
Well, let me add one thing to that.
Please.
And I won't go very far with this, but it'd be a fun thing. Calculate your investor weighted returns of like your retail share class, your institutional share class, and your own investor weighted returns from your own allocations into your own fund. And you'll generally see something very different, right? So what I'm saying, Jason, is do that, but follow up with actual data if you want to do that, so they can see, wow, it's a big difference when you buy the dip and it goes back up versus you buy it after it's been hot for 2 years and sell every time it goes into a drawdown. Like your investor weighted returns, they look quite a bit different.
So I think something that's fascinating as somebody who sits primarily on the allocator side, and especially with all the financial planning frameworks and stuff, and I do in my day-to-day, that relates so closely to the way you're building and thinking about a portfolio. I want to talk for a minute about jump high level, just in case people aren't familiar with this. I want to talk about the capital formation versus risk transfer framework, because I think this is a key part of talking to those clients or potential clients about why do we even think of this world this way. Start us there, and then I want to probe in that a little deeper.
Okay. And let me ask, where did this concept come from? Did you learn about that concept by listening to me, or is this coming from a different source?
This concept comes from you, sir, in many years of fun podcasting.
You just want to make sure nobody else was like stealing his genius, right? Like that's
no. I've always been looking for someone else to cover this topic in more detail than me, right? Because
this is shocking that I would say probably in, I don't know how many years I've been hearing you beat this drum in public, but you're one of the only ones who explains it this way as just two separate areas. And I wish more allocators heard this languaging of how you think about this, which is why let's drill into this.
Yeah, come to think of it, book sitting on my desk, I don't know if you can see that, if it's out of the frame or whatnot, it's called Risk Transfer. And I think it was written by Professor Culp. That's one of the best books in the world, and maybe the best on this topic, I believe. So I'm just plugging Dr. Culp's book. Okay, so I've said in the past that there are primarily two types of financial markets. There's others, but there's two that I concern myself with. One's a risk transfer market, and the other one are capital formation markets. So examples of capital formation markets would be the equity markets, and let's just say the corporate bonds or bond markets, where the purpose is to bring buyers and sellers together to pursue capital formation and investments, right? So if you're starting a company and you think to yourself, I need more capital than I have on hand, I could do debt financing, I could borrow money, and that's going to have a certain, risk and payoff structure and a cash flow situation. Or I could raise equity and just, sell perpetual ownership stake in the company, hopefully a minority stake, in order to get the capital and not have to worry about anything other than just paying dividends after all the bills have been paid. So, one's more flexible than the other, but it all depends on your circumstances, which one's optimal. And usually it's some blend of the two. What do they call that in college? The weighted average cost of capital. You want to minimize that by, optimizing the blend between your equity financing, your debt financing, your short-term debt, so on and so forth. All the CFOs will know what I'm talking about. Risk transfer markets serve a different purpose. This would be like crude oil futures. This would be, in any futures contract for the most part. I guess even the stock index futures, but strictly speaking, a risk transfer market brings a buyer and seller together, not because one of them's trying to raise money, but because one of them is trying to take a certain risk that's on their balance sheet or income statement and get it off. They basically want to put that on someone else. And in a perfect world, they'd be able to find someone who actually wants that risk. Let's say for example, crude oil, people that produce crude oil when crude oil is going up, their profit margins are going up, but only if they lock in the price, right? So they would sell, pre-sell their crude oil by selling futures contracts. And then there are consumers of crude oil who like the price to be low. The lower the price, the better their profit margin. So when the price is low, they want to pre-buy to lock in that margin. And when things are in balance, neither of them is particularly motivated to go out and do a lot of hedging. But when it gets tilted one way or the other, one side is more motivated than the other. So when crude oil prices are high, in theory, the sellers are much more aggressive because they love this price. And the buyers are like, man, I wish I had bought at a lower price. And even if I buy at this price, I can lock it in, but my margins are flipping negative, right? So I'm actually going to need to reduce production on my end. I don't want to expand production when my implied margins are negative, right? So risk transfer market is a way for you, if you're the producer, you can pre-sell in order to lock in a profit margin, or if you're a consumer, you can pre-buy to lock in a lower input cost, which implies a better profit margin. You're essentially buying a form of insurance. I call it an inverted form of insurance, right? So the capital formation markets, stocks and bonds, a lot of people feel like they have an upward drift to them, right? Like that both sides can win and get ahead. In real terms, that's debatable, but I understand their argument that it's not a zero-sum game, that it can create, everyone can win. In the risk transfer market, at least at the future or forward contract level, it truly is a zero-sum game. For me to make $10,000 in crude oil, somebody else necessarily has to lose $10,000 in crude oil futures. So it's a zero-sum game. It's actually a negative-sum game if you factor in transaction costs and the NFA fees and all the other, costs associated with doing it. So why would smart people willingly choose to participate in a negative sum game when they could just take all their chips and go after this other thing that seems to be positive sum where everyone can win? There's a couple different ways to try to answer that question. And one, I think, novel way is to reframe it. It's not really a negative sum game. The negative sum game at the futures level, right? But what my research into this topic, it's because I'm a nerd and I love reading about these things and trying to think them through and see where other people have missed it, where the consensus has potentially missed it. When you're running a company, and let's say you're hedging your interest rate costs, if you're unhedged, oftentimes your cost of capital will be very high if you go to the bond market and try to borrow money from people, because they're going to look at you and see that you're unhedged and assume, probably rightfully so, that your bankruptcy risks are a lot higher, right? If you go out and hedge in a way that, say, loses you 1% a year on the notional value, or maybe 3% a year on the notional value of your hedge, it can lower your borrowing costs so much that it's actually a huge net benefit to the firm overall, right? Because if the marketplace perceives you as having much lower bankruptcy risk, the multiples on your equities can go up and your cost to borrow can go down, right? So it's like, hey, if we sign up for this hedging program where we're just going to lose gobs of money all the time hedging and look like idiots, right? We're going to lose this much, but we're going to make this much more on our entire business. So things like that, there's synergies that can happen that are outside of, is futures a negative sum game or a zero sum game, however you want to look at it. And then there's other things like, let's say you're running a copper mine and the price of copper is really high. And, you're getting pressure from your investors and your shareholders to expand production. And you're trying to explain to them that, like, it's not easy to expand production. It's a big decision, right? We got to hire all these new people, new plant and equipment, new insurance contracts, and it takes a certain number of months to even get things up and running. There's regulations, all this other stuff. If I get the ball rolling on this and 5 months later, after all this hard work, we're finally ready to go, if the price of copper went down, you're singing a different tune now. You're like, no, don't do it. I already spent the money. We spent $20 million or $50 million putting all this in motion. And now you're telling me not to do it? Well, the money's already been spent. And they're like, yeah, but the price of copper is so low now that if you do this, your margins are going to be negative. So you're going to be compounding your problems, right? So both of you guys know what should have been done. When the decision was made to spend the money to expand production, you should have locked in those copper prices at that time. Then you wouldn't have to deal with this, right? So And it doesn't matter if copper prices go even higher after that. Well, I mean, it does, but which was the right decision to make? And that's up to each individual participant. You probably heard war stories about certain companies are unhedged, certain gold miners are unhedged, certain airlines are unhedged, and traders love them because they're more leveraged, right? It's just a cute way of saying more bankruptcy risk, but it's also more upside if you gamble and get it right. So risk transfer markets serve a purpose. That's why they've been around for so long. And that's why they're so deep and so liquid, is because they serve a very valuable purpose to both consumption hedgers and production hedgers at different points in time. And you might be wondering, why is there room for the trend follower to come in and participate in these markets? It's because of that imbalance I talked about earlier. When the market's ripe and production hedgers are the ones that are aggressive, consumption hedgers are very shy. They don't like prices. So the trend follower comes in and takes the other side of the trade in return for something in return, which we'll talk about in a minute. Vice versa, if it's the other way around, well, then the other group is now shy and the first group is aggressive, but it's imbalanced. So you need speculators or, trend followers to come in and take the other side of the trade. So that's me. That's Jason. Why would we do that? Why would we get off the couch? We're lazy, we don't have any skin in the game. We don't need to do this. So why would we do it? Jason, why do we do it?
To try to hedge our own books and make money off of their non-economic reasons that they're taking the other side of that trade. What we view as non-economic in the actual under the exchange, but they have a whole other tertiary reason for doing it.
Yeah, for us, it's like, well, if there's an implied profit,
Exactly.
then I'll do it, right? If the implied profit exceeds the implied risk, given the probability of success, and it's, not completely redundant with what I'm already doing, then yes, you'll get me off the couch and I will come be on the other side of that trade. Now, turns out that trend following, if you analyze it historically, works. It's been very profitable, but it's lumpy and it's uncomfortable, meaning that trend followers, generally speaking, are only successful on about 30 to 40% of their trades, which means, 70, maybe 60% of their trades are losers. And that doesn't sound very good to the untrained. But when your winners are big and your losers are small, that math can work really well. So that's what it takes in the risk transfer markets when they get imbalanced. And they're always, well, not always imbalanced, but they're always moving away from balance. That's just the nature of markets. They exist for a reason. If stuff was imbalanced, these markets would just dry up and you'd see the open interest crash because there's no point. And you've seen this, like pork bellies went away. Futures markets die, usually because vertical integration comes in and there's no seasonality and there's just no imbalance anymore, right? So when it gets imbalanced and there's a motivation for one of those two main participants to hedge, they have to, basically that premium has to get cooked in to the trend, and then the trend followers get dragged in and they take the other side of the trade. And let's just say, for argument's sake, 40% of the time, they're going to make a lot of money from it. And then, 60% of the time, they're going to lose a modest amount of money from it. Now, if you replicate that across silver and corn and cattle and French bonds and Japanese equities and, all these different, the British pound, all these potentially uncorrelated different asset classes, you can blend together something that actually is very nice and it's uncorrelated with equities and uncorrelated with bonds, and it makes money over time. So that's the sales pitch. That's the beautiful sales pitch. Sometimes though, you're going to get whipsawed. That's 60% of the time that you lose. Sometimes the themes and the macro environment is so volatile, and, war and tweets and the Fed and, everything starts moving together. It's not all fun and games. Sometimes it's challenging and painful. And that's what the last couple of years have been like.
Well, it's in the title, right? Risk transfer services. Like, you're taking on some risks they're transferring that risk to you for a time period,
Yeah.
right? And you're looking for it to be profitably. And like you're saying, I'll put a couple of finer points on it that I always love the way you talk about it, is like, if you're a producer like Nabisco, right? And they want to entice you to take the other side of the trade so they can offset some of that risk. And so you're like, over this year, I've taken $5 million in positive P&L out of Nabisco. And Nabisco's laughing because, like, if they're looking at it like within the exchange and that trade, like you said, it's zero sum or negative sum after fees. But they're like, hey, we saved actually in this past year $50 million on our financing costs for our new plant because we hedged out $5 million to, Eric's firm, so to speak. And it's like, so net, you're both winners. And that's what I think is hard for people to wrap their heads around, because they're not understanding there's levels to this game outside of just what's going on in the exchange, especially when you're dealing with these large conglomerate producers. And I think I need to find the video on it if I can, but I think it was pre-GFC, Myron Scholes actually addressed this. He called it Omega. Somebody was asking him a question about risk transfer services, and coming from that pure Chicago school, obviously he's famous for Black-Scholes formula, but people were asking about like whether it was in options or futures, and he said the Chicago school obviously big believers in beta, there is no alpha kind of thing, but he said Omega is a form of alpha in the sense by providing this risk transfer services, you deserve to get paid a fee for providing risk transfer services, so to speak. And that's what he called, the Omega. So it's like alpha, beta, Omega was like a new category for something outside of beta where you're actually deriving some alpha from providing the risk transfer services.
It's beautifully said. And I totally agree. That has been my experience. And that is how I see the world.
So you talk to any advisor, you talk to any RIA who's sitting there, and you hear all the horror stories of like, I allocated to trend once, I allocated to a CTA once, I allocated to one of these strategies and it sucked and it was awful and I never want to do it again and it's bad. And then you come along and go, I know I should just roll it up inside of my business. I should just make this a core part of the strategy. You're not just a glutton for punishment. Why did you have to put these two things side by side together the way that you've paired them together?
There was a few benefits to doing it that way. So to be clear, you're asking me, why did I blend managed futures with passive equities in the laddered treasury bill portfolio? Why not just offer the managed futures on the standalone basis?
Yep.
We talked earlier about investor weighted returns. I've noticed that when you're uncorrelated with what everyone's benchmarking you to, which is either the S&P 500 or a 60/40 portfolio, even if you work yourself to death and you have an excellent track record over a long period of time, your clients have deeply negative investor weighted returns. And the more uncorrelated you are, the worse it gets because they start using you as a hedge. They start timing you. They buy you after a run up. They sell you as, after you've gone down. And I've noticed that it's just hard geometrically to grow and get ahead in life if you're on the wrong side of that social phenomenon. It's very difficult. So I didn't necessarily want to go down that road, unless I had to. Two, it's at this stage, I'm 53 and I wanted this to be my last job. I wanted to do something for 20, 25 years and then fade away. And so I thought, well, what is it that I want to do? And I thought, why don't I just manage my own portfolio, how I want to invest? And this is how I want to invest. I'm not afraid of stocks. Sure, they can go down 50%. Heck, they can go down 90. But if you've got a good systematic global macro program in there that's going to be short those same stocks when they're going down, it takes away a lot of the sting. I can. Unless, Jason will point out, unless you get whipsawed 5 times in a row. But in my experience, in my opinion, systematic global macro is a better diversifier than bonds. So if I got to design the program and I'm not paying someone else 2 and 20 to run it, and I believe it's durable, and I pair it up with really, low fee, tax efficient global equities, and then put the cash in a laddered treasury bill portfolio, manage it all in house. So manage the taxes and the fees and the turnover and the costs and all that stuff. I'm like, I would love that to be my portfolio. Now, will the marketplace buy this from me as well? Will people invest alongside with me so I can have the capital to do this the right way? It's hard to run a good systematic macro program with less than a couple $100 million. There's a sweet spot, 2 to 5 billion is very easy. We could probably handle 14 or 15 billion with no changes. But trying to do it with 100 million it's not super easy. Like you have to skip certain markets and whatnot. So can I convince people to invest alongside me so I can manage, $2, $4, $6 billion, which is kind of the sweet spot in my opinion. And, cash flow, charge a reasonable fee and have them pay me to manage my own portfolio alongside with them. I thought, well, that would be an amazing life. Right. So my team, my equity team, equity partners at Standpoint said, yeah, let's do that. We don't need to do pure managed futures. My background was long short equity, systematic, and managed futures. And so anyways, And it's unique in a sense, right? Now you're seeing a bunch of blended products come out, but when we launched, there were only a couple, and they didn't really have a compelling story. They just had these kind of cool looking track records. And I thought, well, let's give it a shot, and so far so good. We're very happy with it. We're happy with our clients, happy with the business model. It's very easy to run. The two, like passive equities and systematic global macro, are a great team, like they're a good spouse for one another. When one's going down, the other one usually isn't. It's very rare for them to lose money at the same time. Of course, you will experience it from time to time. But also when it comes to like moving margin around and operational complexity and all that stuff, it's like, no, they fit together very nicely. It is not a stressful thing to do from an operational perspective. So I don't know if that's a good answer. It's just an honest answer. One was convenience. This is what I want to do with my own money. If the marketplace says, hey, we like that too, then great. And so far they've given us kind of a thumbs up.
Matt, I want to put a finer point on this though, because what Eric's not talking about was when he was looking to do this, and we had talked about it back then too, is like the entire CTA, managed futures, commodity trend analysis, systematic global, whatever you call it, world, would not pair it with buy and hold equities. It's anathema to them to hold anything but trend following. They think like you do trend following plus nothing. Like you're a loser if you add anything to trend following. And then like Eric's looking at it and you just go, well, the math says if I pair it with buy and hold global equities, I end up with a better portfolio across all my risk metrics. So why wouldn't I just do that? And everybody's like, you can't do that. You're an idiot. Like all this stuff. Like he just took all of the arrows in his back for being a pioneer in this. But then what he's also hinting at is now you're seeing almost every CTA shop I know is trying to roll out a product that overlays either domestic or global stocks on it. So like, Eric, how do you really feel about everybody copycatting you now after they told you you're an idiot for all these years?
Well, I told them all, I told them launch your own. It doesn't have to be most of what you do. It could just be some of what you do. And there's no harm in it. I remember I've had this argument, and I have no ill will towards the people that want to, stay purist and just be pure trend following. That's cool. It's a free country. But I did point out to them, like your own marketing materials show like an S&P 500 with a 10% slug in managed futures. Look at the efficient frontier, and then a 20% slug in managed futures. Look how much better it gets. And then a 30, and then a 40, and then at 50, it's perfect. It's amazing. And then at 60, it starts to go back down. I'm like, so for 25 years, you've been using this, marketing message showing the benefits of blending managed futures with equities, but it never occurred to you to just do it yourself? And no one had an
because
answer.
these are religions. Because they're religions. That's why they don't have an answer. It's not their faith,
Yes.
right? It's a faith-based religion.
Yeah.
What about the market? I think this is a really interesting and nuanced point inside of this too. Why market cap weighted on the just equity beta side? Why is it that simple?
I looked at everything I could think of, and that actually was kind of a bitter pill for me to swallow because I was a small cap, like systematic long short equity guy. And I've done all kinds of research on factors and value and trend following and micro caps, small caps, mid caps. Mid caps have had a much higher annualized return than large caps. And I thought, I don't want to just take the easy way out and ram it all in the S&P 500. And then I ended up doing that. So why? Why did I do, not the S&P 500, but the MSCI World Index, which is almost, that's like 60% S&P 500. Why did I do that? So I actually set out to prove that you shouldn't do that. And I spent quite a bit of time doing the research, and I looked at the turnover and the taxes and the trading costs and the capacity and then the relative performance in real terms for all these different things. And I was just kind of blown away at how competitive market cap weighted large cap stocks have been when you factor in all the costs, right? The turnover, the transaction costs, the tax consequences. Like when you're running a small cap program, there's a lot of stuff that comes off the top and off the bottom of the edges each year due to rebalancing. Like it's not a small cap anymore if it's a big winner, right? It gets kicked up into the mid cap. And then also, they call the Russell 2000 the toilet bowl because every crap stock that's going to zero ends up in the Russell 2000 during its final spin, right? So, and then it gets kicked out of the Russell 2000. So there's just a lot more portfolio turnover in the small cap world. Well, that generates transaction costs, operational costs, and taxes, right? So when you factor all that in, that gap that everyone shows on their charts in their office where they're like small caps, and then mid caps and then large caps are down here. In real, I call it triple net real, where you factor in everything. It's like $100 went in, and then 50 years later, how many bucks came out after you paid everyone, including the IRS? It's not that big. It's much smaller when you factor in all the real life frictions. So, and then to get your short exposure, in the macro program, you have to use the large cap indexes, right? That's where the futures contracts are. So if you want balance between your short positions in a bear market and your dedicated long positions, which you never sell, what you don't want to do is be short large caps and long small caps when there's the huge inversion, like what happened in 98, 99. So there was just, when you factored in all the different stuff, and I repeated this in foreign countries to a certain degree, they don't all have the kind of data that we have in the US. But I found, generally speaking, the same thing, that this perception of the gap between small cap and large cap, most of that goes away when you factor in all the frictions of real life. So I'm like, okay, well, I need to let go of this bias. I've always had a very strong small cap bias and complexity fetish for stuff, but I reconcile it against real life. And convert it into real dollars, triple net after fees, taxes, and inflation to get to reality. And large caps are convenient. They're easy. They're tax efficient. They're super fee efficient, and they just don't lag behind small caps by very much.
And what do you think about, though, like bonds, for example? Like if we think about 4-quadrant model and we're looking at the axes of growth and inflation, and if you wanted more negative correlations where like bonds are literally going to do well in a disinflationary or deflationary environment, and CTA trend followers historically have had the highest beta to inflation, and you'd have that more of an inflation play if you're just directly offsetting with bonds. Like, what do you think about that prospect?
Yeah, I struggled with that one. I thought about it for a long time. The deep dive I did on bonds was kind of similar to what I just talked about. I took the 10-year as a proxy for the bond market, and I went back to, I don't know, sometime in 1970s. And calculated the annualized return, both of the futures contract and total return terms, and then certain bond funds that were around, and then also that guy from NYU Stern that puts out that professor that puts out that spreadsheet every year that's got all that. Yeah, I can't pronounce his name, so I don't even try. Love that guy though. He is very smart and very giving to the community, right? He just provides a lot of information. So, anyways, I calculated the total returns for the 10-year treasury 3 different ways. And then I looked at it, after the fees that you would need to charge, the inflation, what inflation actually happened, and implied trading costs, and that 7% annualized return after everything came down to less than 1%. All right, so that was a great bull market, because I think the data went from like 75 to, when I did this, it probably was 2019, 2020. That 7% return almost gets completely erased after you factor in all the frictions of real life. It's even worse for the shorter duration bonds. So I'm thinking to myself, do I really want this? Especially because going forward, are we going to get something as compelling as a 40-year bull market in bonds where you start with 14% interest rates and finish with 0? I'm not willing to make that bet. I don't even see how that's possible, right? So essentially what I'm saying is the empirical data tells me that the expected real rate of return on bonds is actually quite negative. So I had that in the back of my head. The other thing was, trying to remember, it's taking me back 6-7 years ago to when I was making these decisions.
Taxes aren't great either. That's part of the issue.
Yeah, that's the other thing too, is it was after tax. That's how you get to the less than 1%. So it's fees, taxes, and inflation. Thanks for pointing that out. They eat up capital, right? So you got to take it from somewhere, unless you're going to use futures. But Jason, as you like to point out all the time, or as you or Corey Hofstein, probably both, when you trade futures, you're trading, it's the excess return that you're trading. It's not the total return, right? So if you use futures, that's a different animal, especially for bonds. It's just the excess return component, right?
It's tough. Yeah.
And the risk-free rate of return is what, 4.5% right now? Well, the excess return might be 150 basis points. So you're not really trading bonds when you're trading bond futures. So if you're going to do bonds and get the total return, well, the money's got to come from somewhere, right? So if it comes from equities, well, there's an opportunity cost. Is it going to come from your T-bills? Well, that's just part of the total return to begin with anyway. So it's just, one for one almost. If it comes from the managed futures side, I guess you can try to do that. But long story short, the negative expected real returns going forward played a role. I'll admit that. The bond math is not compelling to me. And the other thing is systematic global macro historically has been very uncorrelated with equities, and generally negatively correlated when you want it to be negatively correlated. The relationship with bonds is not like that. It doesn't blend as nicely with bonds as it does equities. Bonds kind of have had a risk off relationship. But if somebody, was doing the same work I was back then, and they said, you know what, I'm going to do a third in equities and a third in bonds, and then the balance in futures, I would have had zero problem with that. That would have been cool. I had to make a decision though. And I said, all right, what do I want to do? What would I do if it was just my money? I wouldn't bother with the bonds, not on a buy and hold basis. With the trend following approach to macro has a lot of exposure to German bonds, French bonds, UK, US, Japanese. There's a lot of potential bond exposure, both up and down, at least on the excess return portion. And we generally have 25 to 33% of our money in a laddered treasury bill portfolio, rounding out the rest of that total return. So essentially, I've convinced myself that in a runaway bull market, we were very likely to be long bonds anyways. I don't need a dedicated long-only sleeve. But somebody who wanted to do that, I'd have no problem with it.
All right, here's a more philosophical question, perhaps. Not that we haven't already peaked the limits of philosophy in some of this conversation, but I want to ask about this. A very common question right now is, and I'm thinking back the capital formation markets. So we look at stocks and bonds, and it feels like everybody and their cousin wants to talk about the grifts and the horrible things going on in public markets. Is there any other version of that? Or is there anything in risk transfer markets we should be thinking about where there's tariffs, policies, other risks that keep you up at night in risk transfer markets?
Well, they don't keep me up at night because I've been hearing them for so long. But yeah, I mean, you just go on the internet and type in, COMEX versus CIMEX. You'll get every conspiracy theorist planet. There's no gold. It's not really there. Like the COMEX. I've been hearing the COMEX is going to blow up for 20 years now because they are not going to be able to make for delivery and all this other stuff. These people just need to go read the fine print on the contracts. Like if you dig deep enough, it's like, well, if they don't have it, they're going to cash settle at a certain price and bust the contract. That's fine with us because that's what we do anyways. We don't want the physical delivery. So yeah, there's all kinds of, these exchanges badmouth each other, try to take each other's business. Singapore is very good. They're very good at what they do, and they're growing really fast. So I think a lot of people are comparing them to some of the older and more tired exchanges in London and Chicago in the US. So yeah, there's plenty of drama, about that, but futures markets are really pretty simple. It's not a complicated thing. You have a clearinghouse that has variant margin requirements for both parties. If you don't put up the money, they'll close your position out and send you a really mean letter and a bill. And if you don't pay that, they'll come after you in court. If the market goes haywire and one side can't pay, there's insurance, and then there's members of the exchange that are supposed to, put up the money to make good on it. So it's really a pretty simple, durable model. But yeah, there's no shortage of drama and people squawking. We've had issues. The nickel market went haywire a few years ago because I think those oligarchs over in Eastern Europe and parts of China, kind of cornered the market. And we were long nickel when it went up. What was it up, Jason? Was it like 200 or 300% in a couple of weeks, something like that? Yeah, and they halted the market, and we had to figure out what to do. And when it was all said and done, they reopened the market. We took our profits, we closed it, and then we just stopped trading that market because it stopped functioning as a risk transfer market because it just didn't have the diversity and breadth of, hedgers and speculators on either side. It was just a few oligarchs that completely dominated that market. So that's very rare. I think I've only had to make a judgment call like that twice in my life. And it's obvious when it happens, right? Because everyone's talking about it. It's usually in the smaller markets. Nickel's not a very big market. So we don't have to deal with too much insanity. But there's plenty of drama, and stories about how corrupt the CME is and blah, 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 but I don't see it.
What do you say to people when they start to kick the tires on this stuff and they're thinking about, I want an allocation to risk transfer markets in some way, shape, or form? What do you say they should be aware of to not get sucked into that drama? And let's face it, nickel, Russian oligarchs, there's only one way that these football clubs get bought and sold sometimes.
Yeah. Well, it's one of those things where unless you've been paying attention for probably more than a decade or 10,000 hours, you won't know right from wrong anyways. So my best advice would be find managers that, can pass a due diligence test, that have a track record, that have, satisfied, happy clients, that don't have any, marks on their, regulatory judgments against them, and listen to their story and then ask yourself, do I trust them to manage a portion of my money or not? But I'm going to rely on them to do their due diligence. Because like I said, it takes 10,000 hours to learn all the ins and outs of these things.
Matt, I would say a different way. There's a couple of things I can point out on that. One is like, I think the most salient argument maybe against the exchanges is like the treasury basis trade, just because it's so large and people are using a lot of margin there. Like that could move quickly in a direction that could put some strain across the system. But like as Eric's saying, you have the clearing houses have margin. Then below them you have the futures clearing merchants. Then you have introducing brokers, and you have clients, and then you have insurance. Like it's a layer cake of redundancy as far as posting those margins. And crypto or fintech would have a field day with it, but the redundancy is there like a Chesterton fence for a reason, right? Like, so we don't have these issues. So it's like the cleanness, and then more importantly, it's like it's marked to market instantaneously, throughout the day. And so like if you have like a separately managed account and everything, you get to see that trading in real time. So it like you don't have all of these other issues that you have really in the SEC private hedge funds where you don't know what they're doing. Like the trading is above board. It's on those clearing houses. You can see it in real time. And then, more importantly, like, and then you can hold your collateral in T-bills. And I think historically, decades before, maybe some maybe your older clients may be a little bit burned about people trading, futures and stuff and using crazy margin. But like you can really delever these things. The leverage is not necessarily has to be used, right? Like the way people are going to trade it prudently, they're going to lower their target vol of their portfolio, et cetera. It's not going to be like this swashbuckling 1970s, somebody running 80 ball and just trying to like blow out the account. At least on the professional side.
Yeah, it's very hard to hide losses, right? Because like you said, everything's marked to market and it's transparent. And this is a clearing house that has to report, publicly what's going on. And every contract of open interest, is accounted for, right? So it's not opaque at all. It's anonymous. You don't know who owns the contract and who's short, but that part's not relevant. Just that they posted the margin and that variance margin is being enforced every day. And if they don't make good on it, the exchange steps in, kicks them out, closes the position, and moves on. So it's not like these opaque markets where you don't know, like you find out later on there's 60 billion in losses no one knew about. Like that requires, secrecy and a lack of mark to market. So yeah, let's not talk about private equity today. All right.
Yeah, exactly. I wish we could all make our own quarterly marks and say what the value is or make them up internally. That'd be phenomenal. We've had unbelievable products, right? We'd have no drawdowns, no volatility,
what Sharpe ratio do I want today?
Exactly.
Get it done.
So earlier you brought up like kind of like we were talking about like pairing this with like long only equity or other things, and implicitly we're talking about correlations. And I'm curious, we were talking about the 70s earlier, is like how do you think about, regime dependent correlations? Like a lot of CTAs will run their book where it's like a quarter each, right? In financials, FX, say energies, metals, or softs, like they'll kind of like run a certain portion of their book, and because they're relying on kind of the uncorrelated nature across those different sectors. Do you think about like right now we might be in a new correlation regime across those sectors? Do you worry about that at all, or you just take whatever's trending and just kind of put it all in the book together and it'll take care of itself, or do you have kind of brackets around that and think about those correlation regimes? 5 questions in there. In one.
Yeah. Well, I wasted 2.5 years of my life chasing every correlation ghost and demon on the planet. I wish I could get that time back. They used to call me the correlation king. Like I've spent so much time trying to analyze, every form of co-movement, co-integration, covariance, copulas, everything, right? Because I was convinced that I had a small cap bias, a complexity fetish, and I really thought that the degree to which things are independent from one another is very valuable information that you can harvest a risk premia by correctly estimating the degree to which things are independent or correlated or non-correlated with each other. What I found, though, through the research is that there's this interesting phenomenon. Trend followers tend to be highly profitable when the correlations blow up and go extreme and become high, right? So I remember one project I did. I would measure the cross correlations in the portfolio. I've come up with like a portfolio redundancy score, like how much diversification does this portfolio really have? So the less joint co-movement between your assets, the higher the diversification score. And if they're all moving like a school of fish, the lower the diversification score. And I thought, well, okay, so if you allocate more risk when you have higher portfolio quality, more diversification, and you become risk averse and you manage risk more tightly when everything's moving like a school of fish, you'll do better. Not true at all. It actually gave you the opposite result, right? Because the profit expectation, the mathematical expectancy tended to be higher when things become highly correlated. That's what I found, right? So I'm like, wow. Now, there was some benefit to identifying markets that are independent, but still highly volatile. Like even today, if I were to take that approach, it would tell me to, trade natural gas more aggressively because it doesn't move like anything else. It doesn't move like the other energies. Lean hogs is very independent from other assets or other futures markets. It doesn't move like cattle. There's a couple other, I think cocoa is very independent and whatnot. But, for the other things like the correlation between stocks and bonds, the correlations between energy and stocks, sometimes the correlations are high, sometimes the correlations are low, sometimes they're low and you reward that and then they become high and then you're kicking yourself, So anyways, what I found is these correlations jump from one regime to the next and they'll stay in one regime for 6 months and then implode, or sometimes it's 2 years and they implode, or sometimes it's only a few weeks. It just becomes maddening. And now you're chasing so many different parameters and variables that I found that I expect to be much better off if I just assume everything's going to become 100% correlated and go against me at the same time. That's my assumption because it will happen someday. And that's what I'm managing my risk off of. Now, when that's not the case, I get a higher, risk adjusted return or whatever, and I get less variance than I signed up for. But I'm looking at the worst case scenario, and I'm just always assuming that I'm going to have a 100% failure rate on all my trades. It's going to be 100% correlated. They're all going to go down 10, 12 standard deviations, hit my stops. I want to know what that number is. So is that optimal? No. Right. And am I going to be right on that very often? No, but I have to live with it and it will happen at some point in my career. So that's what I do. So that's a long-winded answer or a long way of saying, Jason, I did all that work to the best of my ability and found it just to be too complicated, too fragile, and too squirrely to try to make sense out of. And at the end of the day, the blunt instrument is I'm just going to assume everything's 100% correlated when it's going against me. And that's how I'm going to do my position sizing.
Okay, that leads to a great question on position side, but like you just hit two of my pet peeves. Is like one, when everybody talks about like Sharp or something, they talk about their CAGR and their vol, and I'm like, it's not volatility, it's variance. So you hit that perfectly, the variance. And then when people bring up correlations, I'm like, you have to use both C's. You have to say conditional correlations because there's no such thing as correlations, right? From that time you took it, that's what it's good for. That's about it. It's like Schrodinger's cat, right? It's conditional correlations. But then, okay, so then say more, how do you position size then?
Yeah, so I have a risk budget, and I think in the macro program, it's about 10%, but generally speaking, unless everything's at, a new high at the same time, it on average is somewhere between 7 and 10% position sizing. And then you have to spread that out over all the positions in your macro portfolio. That might be 30 positions. It might be 50. It might be 42. It's changing depending upon what's happening, right? And then because we want something that has a lot of capacity, we open interest weight our positions, right? So what that means is that if we get a signal to go long crude oil and a signal to go long heating oil, our crude oil position will be much bigger than our heating oil position because crude oil is much deeper and more liquid market. Likewise, gold versus silver. Gold's just much bigger than silver. So you could think of it as market cap weighting. It's just we're using open interest as our metric. for, but still that 10% risk budget is honored, then it's divvied up and allocated out based upon the open interest in each market and the distance to the stop loss. So it's just some simple algebra to make sure that, your total risk is about, 7 to 10% in any given time, but it's allocated out based upon each trade's stop loss distance and its open interest. If that makes any sense.
For stop loss distance, are you using like ATR, for average true range, like classic stop loss distance, or are you using a different metric?
No, it's just a portion of the range. So if you're looking at a 1-year high as a breakout, it's just, basically 1/3 of that high-low range over the year. If you're looking at a 9-month breakout, it's 1/3 of that range. I tested every kind of stop I could think of. ATRs, parabolic stop, chandelier exits, moving averages, smaller channels, half the channel, like all these different things. And there's a durability robustness zone that you zoom in on. And you're like, okay, all these stops are all these different methods. When you do the scenario analysis and you optimize for durability, not for profitability, but how stable and how effective is this over time, they all kind of gravitate to these same zones, no matter which method you choose, right? And that was, more or less about 1/3 of the range of whatever your trend length signal is. So whereas different entries work, like 6-month highs, 1-year highs, 2-year highs, like they work. They work at different times and in different ways, but they're generally effective. When it comes to stop losses, you don't have the breadth of range, right? Like there's an area where you just need to no longer be in this trade. Now there is a range, it's just not super wide. And what you'll find is that optimal stop loss, the one that's durable across all different markets and across continents and decades, happens to correspond with the psychologically toughest possible time to close out this trade, right? It's just not fun. It's not close. It's not a tight stop, right? But it's still close enough such that you're like, now, really? Now you can't give it more room now that it's, it's already, it's just psychologically and socially and politically, it's the worst possible spot to put it. And that makes total sense to me that that's where the optimal stop loss level would be. And I think it makes sense to Jason too.
So you got your breakout. So then you've got your open interest weighting, you figure out your position size, you've got your stop loss. Tell me the pros and cons of whether somebody should want to volatility target or variance target that open position as variance increases on you, as it maybe moves in your favor. The ultimate question in our community, right? To vol target an open position or not.
So you're talking about like an individual position when it gets
Yep.
way too hot, do you resize it back down to?
Yep. You trim.
Well, again, I've done all that work, where you basically set up a rule and say, we'll try every possible setting for this, from, you're really aggressive at rebalancing to you become very liberal to you don't rebalance at all, and apply it to all your positions and hit go and then produce, 500 different equity curves. And you can see the impact, right? Like it cuts your variance, you give up a little bit of return, you get a smoother ride. And then there's a point at which there's diminishing returns. And then there's a point at which it actually starts to harm. So you can do all these things. If you factor in like operational costs and transaction costs and all that stuff in, you'll see that the more you trade, the more it degrades, right? So I'm not a purist where it's like, no, you never resize a position, or, you have to rebalance every single day. Like it's the truth is it's subjective, and you've got a personal utility function, right? And there's a spectrum in there of outcomes and results, and you can choose where you want to reside in that spectrum if you model it out correctly with the transaction cost factored in and the compounding the returns over time. So anyone who says don't ever do any of that is on the one extreme of the spectrum. And someone who says you need to rebalance, with the trade blotters going to your brokers every hour is on the other end of that spectrum. The truth is rarely at one end or the other. So, but it's rarely in the middle either. It's usually tilted towards one area. So my bias was towards active rebalancing, and being much more proactive. It turns out my bias is wrong. It's actually, you want to be on the other side, kind of at the 25th percentile. You just don't want to trade unless you have to. But if things get out of whack, yeah, you need to go in there and make an adjustment to bring things back into line and let those risk units flow over to the rest of the portfolio. There is some benefit to that.
I would guess those like they're using the risk units is that's at the time you probably end up trimming more than anything else is just because you've hit your total risk limit across the book, right? Like, and you've had more breakouts. Is that where you end up trimming more than any other time, probably?
Yeah. I mean, that's portfolio heat 101, right? Like if you start off with, you got 20 trades on and you're at full heat and, a plethora, say another 10 or 15 trades come in. Well, you either have to skip those trades. That's one option. It's not a good option because it could be that all the new trades are from a different sector, the one that's going to work, and the old trades are from 2 other sectors that are getting tired and going to die. It's a bad idea to skip the trades. You can abandon the old trades in order to take the new trades. That's a bad idea too. Or you can just scale down the old trades proportionally to free up the risk units to finance the new trades. That's plug and play and plenty of software programs. It's standard practice. Tom Basso and Ed Sakota and Van Tharp have been writing about that stuff since the 1980s. So it's a personal choice how you want to handle it. I don't like making concentrated bets. So I try to accommodate, all the new trades and treat them, position size them how they should be, based upon all the information that's available to me at that moment in time. And then if circumstances change and a whole bunch of new trades come in 5 days later, then you free up some risk units from these guys, you finance them. It cuts the other way too. If you dump a bunch of trades and now you're not taking enough risk, maybe you need to size up your remaining trades to get them back up to par. So, yeah.
Matt, I was going to say, I got a couple more wonky questions and I'll throw it back to you, but they're hopefully relatively quick.
Give me the wonk.
Yeah, thinking about like roll logic, that's one of the other, unique parameters to trading futures, right? Like you constantly have to kind of roll as contracts come up for expiration, but you want to smooth out kind of your return profile and your P&L. I'm just curious how you think like what your internal kind of roll logic is, how much you guys trade in front month versus back month, you're using quarterlies, how much do you roll and in what anticipation of that quarterly expiration? I'm just curious how you think about that.
Yeah, so as another interesting bias-based story, I've always been strongly biased towards trading the whole futures curve. I thought that if you trade, wheat and corn a year out, cotton a year out, that there would be less speculators in those deferred contracts, and therefore the implied risk premiums would be larger. When I did all the research into this, I found out it's just not true. If anything, it's slightly untrue, just not very much. There is extra capacity that you can get. Like if you really like cotton or canola, the front month contract might be 50% of the open interest. And then the next contract out might be 20. And then one after that might be 8. And so you can almost double your position size if you're willing to trade the whole curve in markets that have a curve. Things like the VIX and short-term interest rate contracts and a lot of the perishable commodities. And then there are things that crude oil has a curve. You can trade 14, 16 months out if you want. And you can really increase the amount of open interest and volume that's available to you. I mean, a general rule of thumb is about half the volume and open interest is in the front month contract for perishable commodities that have a curve. And then you have commodities or futures contracts that aren't perishable and they don't have a curve, like bonds and currencies. Gold doesn't have much of a curve because it's not perishable, right? It does have a curve. It's just, almost everything's in the front month. Same thing with silver. So for certain markets, if you want to get big, and we'd love to get big, you need to go source those deferred contracts if you want to source that open interest, if you want to try to maintain balance. So we have the ability to do that. It's a part of our research. We don't do it right now because we're not big. We don't need that deferred liquidity, but that's just a toggle in the software. As soon as we flip it, then we will just start to source that. And the performance difference between that approach and our current approach is very nominal. It's slightly lower returns, but slightly lower variance and drawdown as well. So, at least by my calculations. So it's something that's a good problem to have if we ever are fortunate enough to become, like 2 billion and we need to source those deferred contracts. But I was of the mind that they would have added value in risk-adjusted performance returns. But And I tried to prove that to be true, but I ended up proving that it's just not true, at least in my research. So does that answer your question, Jason?
Yeah, and a lot of these CTAs start up, right? Floor traders, then we move into separately managed accounts, and then mutual funds where the place for kind of CTAs or managed futures. Then now we're seeing ETFs, but there's some unique trade-offs between ETFs and mutual funds. One is like you're still taxed either way if it's an ETF or a mutual fund, but you're turning K1 maybe into 1099 the tax rate, which is beneficial. I'm not going to argue there. But one of the things you kind of hinted at earlier when we were talking about like the London Metals Exchange and trading nickel there, that's like outside the U.S. markets. And when you want to put these strategies into an ETF, one of the trade-offs is you need a market maker to do is to create, redeem, and to be able to hedge their risk. So they're typically only going to use some of the bigger contracts that are traded on like the CME. So like, how do you think about the trade-offs there? And like, what's interesting, like you said, you building it to grow. So building it to grow would mean you could probably get in those 20 most liquid markets that you could get an ETF, but still you're building to grow, but you still had like the cocoa trade on where like maybe a lot of the ETF traders did not have that for their trend following. So there's an interesting trade-off where you can grow large, but you're still getting some of those idiosyncratic trades that may not be in the ETFs. And then there's also a function around timing of closing out your trades, and maybe tell me like the slight nuance difference between running a mutual fund versus an ETF.
Yeah, well, I chose a mutual fund for a couple reasons. One, I already had experience doing it. And when you run it in a mutual fund context, you're in control of everything. It's just I wait till the end of the day and I get a report that says, here are the inflows and the outflows. That number gets dumped into the software. I hit go. The software runs all the models and it says, hey, you had outflows today, so you need to close a little bit of each position tomorrow. Or if there's a bunch of inflows, thankfully, it's like, well, you had 40 million of inflows, so you need to go increase your position sizes a little bit tomorrow. And I place the orders to do that, and I send them to the broker, and the broker communicates back to me what they did, and I communicate that to not the transfer agent, but the administrator. So I'm in control of everything. I know what the flows are doing. In an ETF structure, because there's a secondary market, there are market makers. They're interacting with your clients, right? And they're charging a bid-ask spread. And if they do a bad job, your clients get upset, but they don't call the market makers. They call me, right? So it's the responsibility and the accountability are now out of whack, right? And I've done that in life before, and it's not fun because there's nothing you can do other than you call the market makers and they're like, get lost, like, you're not big. Until you're at $10 billion and you're writing checks to us, we don't care what you have to say. That's my fear. I don't know if that's actually true. I've actually heard some people tell me the market makers do a good job these days. But a couple things you brought up are valid. Market makers concern themselves with the ability to, because they're taking inventory, right? They're making a market. So
risk transfer services.
Yeah, they're providing a risk transfer service, and they don't want, they're only making a little bit of money. The bid-ask spread, the scalp. Why should they take overnight risk? So if they can't find somebody else to sell it to later on, or early on, they may want to hedge their risk. But if half the positions that you hold in the portfolio are overseas and they're closed, how do they hedge the risk? When it's 2:30 in the afternoon in New York and half our portfolio is Singapore, Japan, Australia, France, UK, and Germany, there's not a lot they can do except for some of those markets have an electronic session after hours or pre-market, but not all of them do. And it's, that's 3 a.m. in Japan. So good luck with that. What are they going to do? They're going to have a wider bid-ask spread, right? So in I've done the analysis on those bid-ask spreads, when it gets to be 18, 20 cents and you factor that in, that can double your net expense ratio. It's a lot of money over time. At least the impact is. So, that's my concern with ETFs. Now, if you had and then the other thing too, is even if you have a domestic only portfolio, right? And you're not trading anything in Europe or the US, futures markets close at different times. A lot of them close an hour and a half to 2 hours before the stock market closes. Well, when do ETF investors generally trade? On the open and on the close. So if they're coming in at the close, but cocoa and gold and crude oil are already closed, the market makers are like, okay, I can look for the after session, which in a lot of cases it's there, but for a lot of the grains and softs, it's not. So it can just get kind of messy. So my hat's off to the guys that are doing an ETF format, and I hope it's going smoothly for them. and they tell me it's going smoothly, and I can just launch an ETF someday and have it go smoothly for me too. But for my first attempt at this blended approach with my new macro strategy, I was going to stay in a format that I knew I could handle, and that's the manage. And I don't see a lot of the big firms rolling out ETFs yet. I guess, well, that's not true, because didn't BlackRock and Invesco just launched managed futures ETF? So, yeah, I'll be curious to see how those do going forward. And Corey Hofstein over at Newfound, he's launching all kinds of stuff, and it's working well for him, so we'll see. I'm not totally closed-minded on the ETF thing, but I wasn't going to start there.
Yeah. But my other question I always ask you, how's the open interest on Bitcoin futures? How long before they get added to your strategy?
It's still pretty small. I think the last time I checked, they were about the 74th largest futures market. Not because the open interest has gone up, but because when you multiply open interest by price, that's the price has gone up. So, but I struggle with that one, Jason, because half my clients want it in there and the other half, don't want it in there.
They run for the hills and you put it in there. Yeah.
Well, and it's such a small market that even if I put it in there, it's not even going to create a rounding error at the end of the year. So neither of you are benefiting. There's no real benefit or detriment because it's such a tiny market anyways, at least compared to all the other futures markets. So, I hesitate to put it in the portfolio since it's not even going to move the needle. Now, if it was going to move the needle, we're going to have to make a decision. And my decision would be to put it in there, actually, because we're in the job of participating in the risk transfer markets. And I don't have the authority to say, the Bitcoin futures are not a real risk transfer market. Why wouldn't they be?
Yeah. Matt, I got one question at the end, so I'll throw it back to you and do.
We'll let Jason take us out on this one, or after this one. Here's the question that we've been asking people. What's something that you would say the majority of your peers, I'm going to put big air quotes on this, so not just the complexity fetishists, talking about peers in general, could be asset management peers. What's something you think your peers disagree with you on where you think you're right?
That's changed over the years. In a lot of cases, they were the ones that were right. And I was able to learn that without, risking client capital or my own capital, I'm very good at learning vicariously through the experiences of others. Some people feel like I'm stubborn. I'm stubborn in the beginning, asking my questions. So in a pursuit of truth. I'm not stubborn at the end with the answers, right? And I always try to give credit where credit is due. So what's something that I'm right about that everyone else is wrong about? Is that your question, like right now?
Yeah. What do you think they disagree with?
Or that your peers would
on?
disagree with, or they would disagree with you on?
Well, a lot of them would. It depends on your definition of my peers. So a lot of people disagree with my statement that managed futures is a better diversifier than bonds. Most advisors, most people. But I don't think that's your question. Those aren't my peers. So you're saying in the managed futures.
That's the layup one that I could easily see. So now if you can narrow it down, if you can, it's okay. But I'm just curious how you would think about it.
Like I brought up earlier, all your peers disagreed with you about adding buy and hold, equities, and then they all came around to your right.
They all came around.
Yeah, so that's what I mean by it evolved, because that used to be the obvious answer, right? Yeah. Probably open interest weighting my risk allocation. I think a lot of my peers would say, well, now, like small markets like soybean meal and, Kansas City wheat aren't going to have enough risk. And you're just putting everything in crude oil and gold and the S&P 500. I think a lot of people disagree with that. Just like a lot of people disagree with using large cap global equities as your equity market beta. And that's okay, right? But when you do the math and it's like, all right, if you want to have the capacity to manage a few $1 billion, you can't ram it all into the micro cap stuff, and you can't do it with canola, right? Like you're going to hit the position limits. You can't do it. And then I look at the really successful firms historically, like the AHLs of the world and, Bridgewaters and whatnot. And it's like, they were doing this with billions of dollars for decades, back when billions was enormous, right? There's no way that they were adhering to your philosophy if you have to treat every tiny market the same as you treat, gold and the S&P 500. And they were the ones that were successful. So you're just wrong, or at least have been. You might be right going forward. That's possible. And then I do my own research, right? Because like I said, I used to be one of them. I used to have this just amazing, scarcity small cap bias. I was absolutely convinced that spread trading, tiny agricultural markets, that's where all the alpha is going to be. And I did the work, and it's just not true. So I'm comfortable saying, all right, I'll just roll with the big boys and do what the big boys are doing because they've got the scoreboard, the track record, they've done it, right? And then mathematically, it's not even possible for me to manage a lot of money with these tiny spread trading things or where I'm equal weighting canola with the S&P. So it's not even doable. But I think a lot of people, I'm not sure if they disagree with me like in truth, or if that's just part of their marketing message where it's like, hey, we're small. We don't want to be small, but our edge is we can treat canola the same way we treat, crude oil. So invest with us. It's important to do that. I don't know. But the empirical data doesn't agree with them. So I don't either.
I know as your peer, what I disagree with you is that your what you call your Civil War diet is really just a paleo diet. But you can't help yourself. You're so independent. You had to come up with your own naming schema for your diet. I get it totally. But semantics.
Yeah, I've got my own dictionary here. I notice that when I talk with people that are like CFA types, or they just had a lot more schooling than me, I'll be talking about something and I use all these terms and they're like, well, you're basically talking about principal component analysis. And I'm like, what's that? And they go through it and I'm like, yeah, that's what I'm doing. It's all those things. And it's called PCA. And I'm like, oh, PCA. And then I go read about it and I'm like, oh, I did this the hard way. Like I figured out all this stuff. I'm like, cause I didn't do the CFA route. I didn't do the formal training on it. I did this and everyone tells me that they're like, what you do is correct. You just do everything backwards and you kind of invert things the way like it's correct. But at first I had to think about it. And like your equation is this way, but if you just move these variables over here, it's very similar to what we're doing. I'm like, oh, that's kind of cool. So, but the path, the journey to learning these things is just different. I've always been weird like that. I learn differently than other people.
Perfect. Speaking of weird, that was where my question was going is like, was it the Greek poet Archilochus talked about the parable of the fox and the hedgehog that then got popularized by Isaiah Berlin. And the idea is like the fox knows many things where the hedgehog knows one thing. So I'm very curious as, usually people that are foxes are entrepreneurs, or you could say that managed futures is trading 60, 80 markets. So you're trading a lot of things. You have to know a lot of things, but you always say, this is what I want to do for the rest of my life, which is very like a hedgehog statement. I'm curious if you see yourself as a fox or a hedgehog.
Yeah, a little of both, actually. Not that I have a split personality, but I have a need for having both. And, but primarily on a day-to-day basis, being like a hedgehog. Like, well, it's because it's what I'm good at. I'm just very, very reliable at showing up. I'm not emotional. I don't use drugs. I don't even drink. I sleep like a baby every night. Like I'm very reliable for the short-term stuff that needs to be done every day. I will not let you down, right? I'm also very good at long-term thinking, like seeing around the corner, seeing like systems thinking about like, is this even headed in the right direction? Like, where does this end up in 20 years? But I absolutely suck at everything in the middle. I'm atrocious, so I partner up with people that are really good at that medium-term thinking. I don't know if that's related to what you just said, but that's what popped into my head is that, in some ways I'm a hedgehog, short term, and I'm very much a hedgehog, and I'm very much a fox about the long term stuff. But whatever that thing is in the middle, I just don't have it.
Do you have an animal for the middle, Jason?
No, I'm gonna have to think of one. No, you're usually quick on the draw. Yeah,
I don't know. Yeah. I'm gonna go with the armadillo.
We have to use AI to create a hybrid fox hedgehog. Is what it like. That was the evasive answer Eric was coming up with. Well, I'm a little bit of both.
Look, here's the thing. I'm half Scottish and half Persian. Right. So that is the strangest mix you're ever going to come across and probably the only one in the world. So, I'm just a weird one with some strange abilities and some strange habits that don't make a lot of sense. So it's probably why I'm still single at 53.
We'll get him a Persian rug kill, we'll get something like that for him. We'll see if we can get that going.
A rug kill. Yeah. Okay. That's
I know somebody used to deal in Turkish rugs, so we can ask for a favor. Eric, thank you so much for coming on Access Returns. If people want to follow you, find you, bug you on the internet about why you're wrong about all these things.
Yeah, cool. Yeah. Just go to standpointfunds.com. And if you want our, monthly package, just scroll down a little bit and put in one of your email addresses. We won't spam you. Just send you our stuff each month. And that's how you can stay up to date with what we're doing.
Highly recommend you do just that. Like, comment, subscribe, leave a comment below, and we will talk to you soon. Thanks, guys.
Thanks, guys. Take care.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.